Hey everyone, I'm Eric and welcome back. Today I want to talk to you about the stock market. I want to talk about how very little I know about it, why I decided to invest in it anyways, and how I got started. Wall Street, at least to me, is a wildly complex beast. It's even intimidating, yet so intriguing. A couple of years ago I was having coffee with a coworker and he was telling me how he had made some decent money in the stock market, even enough to pay off one of his car loans at one point. He had invested in some companies like Bank of America and Starbucks. During that conversation he told me about a company that he had his eye on. It was called Dry Ships. So I pulled out my phone and was looking at the stocks app trying to follow along with him. I saw that this company's all-time high, which was recent, was $190,000 per share. At the time I was looking at it, the current price was about $4 per share. My vision turned green with cash, so I promptly opened an E-Trade account and bought about $50 worth of their stock. I daydreamt about the price per share going up to even half of what its all-time high was. And then I would be swimming in massive piles of cash. Well, within a couple of months, Dry Ships did a few stock splits and I lost my entire investment. Now the company merged with some other company and they don't even exist anymore. And that was the end of my experience with the stock market. Now I just recently started this financial journey, and with the overarching goal of financial independence and passive income, I decided to take another closer look at the stock market and actually learn something before just throwing money at it this time. So here's the very little that I learned, but was still enough to make me feel confident in making a couple of investments. So just a quick segue here. If you want to keep learning and growing with me to build a better financial future, please subscribe if you haven't already. Now there are two basic types of stock market investments. That would be day trading versus long-term investments. Day trading is what I thought I was going to do with Dry Ships. This is essentially taking advantage of short-term fluctuations in an asset's price, trading over minutes, seconds, sometimes days. Some people are very successful at this and do it full time, but I am not even close to understanding enough to even try this again. Long-term investments are where I'm putting my money. This is essentially where you buy shares of a stock or fund and forget about it. And this is why. Over the last 100 years, the average stock market return has been 10% annually. As you can see, there are huge gains and then huge losses. People who try to time the market for these booms or recessions either make it big or lose it all, like me. But if you just leave your investments alone and ride the waves, the highs and the lows, over time, you will come out on top, as long as you're diversified. So being diversified in stock is having investments in multiple different industries and then even different companies within those industries. Let's just pretend for a moment that, say, in 1994, you decided to invest in a company that manufactured telephones. This was a great time to invest in this market because the cordless telephone started becoming a pretty big deal in about 1995. Since it was booming, you decided to put all your money into that one company. Well, fast forward to today, and that industry has shrunk more than 40% just since 2008. Regular telephones have been made virtually obsolete by the invention of the cell phone and the ever-increasing popularity of our smartphones. Most people don't even have home phones anymore these days. So if all your money was in that one industry, you'd be losing all your money today. It's normal for certain industries to face periods of growth and then decline. A lot of times when one industry struggles, another booms. Does the struggle cause the boom, or does the boom cause the struggle? Which came first, the boom or the struggle? For example, telephone manufacturers are struggling really hard right now, but cell phone and tech manufacturers are booming. Think of it as a balancing act. If your investments are diversified in many different industries, then if one particular is struggling, you have all your other investments in different industries to carry you. All or nothing was not the route I wanted to go. So here's what I did. Last month, I got $150 for my birthday. Thanks, Mom. And decided to use this money to give it another shot. Except this time I would take a more reasonable and responsible approach. After some research, I decided to download the Robinhood app and use that platform. They offer zero commission trading, which means I'm not losing money every time I want to buy or sell a stock. Robinhood was really the pioneer on this front, as other companies like E-Trade would charge you a fee every time you wanted to buy or sell. Plus, Robinhood was offering a free stock just for signing up, and there were no fees or anything to sign up. And just FYI, this video is not sponsored. I'm not affiliated with Robinhood in any way, shape, or form, or receiving any sort of compensation for saying any of this. These are just my opinions based on my experience. So I signed up and put my $150 in there. Just for signing up, I got a free share of GoPro worth about $4. I took my first $10 and bought 34 shares of a company called Zomedica. It's a pet pharmaceutical company that might be on the verge of a cancer treatment. This was the one gamble I was willing to take, and I capped it at $10. Since buying the share at 27 cents per share, the price has gone down to 12 cents a share. With the $10 gamble out of the way, I started looking for stocks that offered a dividend and showed stable, consistent growth. A dividend is a percentage of that company's profits divided amongst its shareholders. This is usually paid out quarterly. This is a perfect example of passive income. I'm making an initial investment, and as long as that company turns a profit, I'm going to get a cash return. Plus, the share of that stock that I bought is going to continue to go up in value. So I decided to buy one share of PetMed Express for $24.32. I decided to buy this one because they offer 4.1% dividend and have shown stable, consistent growth year after year over the last 5 years. I then received 4 other stocks worth a total of about $20 just for getting my wife and a couple of family members to sign up. So my plan is to invest the rest of the money in an index fund. An index fund is a perfect example of a diversified investment. It's essentially a stock that's made up of a bundle of stocks. And the idea is that it follows the market index. For example, if the market as a whole shows growth, your index fund will show growth. This makes sense because remember that historically the stock market has trended upwards for the past 100 years. I'm still deciding, but I'll likely do the Vanguard Total Stock Market ETF. They say with ETFs you double your money every 10 years, and then I'm going to leave it and forget about it. So basically I'm going to invest in stocks that offer dividends and show stable and consistent growth, and I'm going to invest in index funds and ETFs. As far as the stocks that I got for free, I haven't really decided what I'm going to do with them yet. I'm considering just leaving them and seeing what happens. They are randomly chosen, so I'm basically automatically diversified. In my last video, I mentioned you need money to make money, and while I said that was mostly true, but not always true, this is a good example of making money with no money. You can create an account absolutely for free, and you'll be given a stock absolutely for free. You can hold that stock, you can sell it and use the money to buy a different stock, or you can sell it and just take the cash. That's free money. There's really no reason not to do this. If you decide to, use my link in the description and we'll both get a free stock. Just don't get sucked into checking the price of your stock every 2 hours, and resist the temptation to sell your stock when it's worth more than what you bought it for. Leave it alone. History says that despite the ups and downs, over time, you will make money. That being said, if you buy a stock for about $4 per share and the price suddenly surges to $190,000 per share, sell that shit. Thank you guys so much for watching. If you found any value in this video whatsoever, even if it was just entertainment value, I would love it so much if you would take the quarter of a second just to hit that like button down there for me. As always, leave any questions or comments down below. I'd love to interact with you guys, and until next time, make it happen.